Good morning, everyone, and thank you for joining us today. Thank you for coming to today's webinar. My name is Fiona Raystrick, and I lead our Economic Crime Advisory team. I'm joined by my colleagues here today, Michael Knight-Robson and Johnny Atwater. First thing I want to say is to all of you that at BDO we hope you and your respective family, teams and loved ones are safe and well during this difficult time. Just wanted to touch on a few housekeeping points before we kick off today. The webinar is going to be recorded and we will circulate the slides and recordings later in case you missed anything or you wanted to share with your colleagues. Your lines will automatically be muted throughout the webinar, so don't worry about any background noise that may occur. Please do submit questions to the panel throughout the session using the Q&A box, which is on the bottom right-hand side of your screen. Please ensure that you send questions to all the panelists so we can all see them, and we'll try and cover off as many as we can at the end of the webinar. We've left some time at the end for Q&A. If you also have any problems with the sound, you can't hear us, the quality gets a bit dodgy, then also, again, message us via that Q&A box and we can see what we can do to resolve it. What we will be covering today. So the COVID-19 pandemic has led to unprecedented global challenges. You'll have heard that word a lot, I'm sure. Human suffering and economic disruption, and it will continue. It's going to be therefore no surprise that criminals are obviously trying to take advantage of that and benefit from such disruption and challenges to further illicit funds. Therefore, we want to discuss today the risks and threats we're seeing, and also looking at your AML framework, what controls you need to enhance or what you may have already considered enhancing or amending to mitigate these risks, either during the lockdown period or as we move into the new phase of the virus. So where are we so far? Obviously, the first case was confirmed in January, and we, in the UK at least, all entered lockdown on the 23rd of March. Although we can see that coming to an end, what end looks like I'm not completely sure, the AML measures that a number of you have had to adapt to over the last few months will likely be continued going forward, as it's going to be more of a new way of working. The views that will be provided today have been formed by looking at the various papers that have come out of the regulators and statements from the likes of FATF, the FCA, the SRA and the NCA, but also our work on a number of still person reviews that we've been completing during lockdown, fully locked down. One of them actually hadn't even started, so that's been completed completely under lockdown. So we're getting themes and messages from the FCA on that as to what they're seeing, what they're thinking around how firms should be responding to the threats that are arising from this crisis, but also the situation that presents itself. So what are the impacts on the regimes themselves? The COVID-19 pandemic has obviously impacted both government and private sector's ability to implement their obligations, and this has had a wide-reaching effect. This is primarily due to the fact that we are all confined and there are social distancing measures in place that has obviously been put in place to contain the virus. Many of the government and private sector employees in this space are now working remotely, but also in terms of people like the FCA, a number of the supervision staff have been redeployed onto COVID-19 responses. And we've seen a number of the teams that we've been working with on skilled person and other work where the supervisors have been redeployed and things moved around so that the decks have been shifted slightly. From a supervision standpoint, so the first bubble on our screen. From the FCA, there have been no current on-site visits from the financial crime team. They have still been obviously engaging with firms, but actually the approaches that they've been taking have been more restricted. And obviously the FCA has been providing flexibility on things like filing the firm's rep-crim forms. And so they're aware that obviously firms are having challenges with data and with accessing information, etc., and they're mindful of that. They have also delayed issuing new licenses to firms. So I think generally, because of the response to COVID, because of all the additional work that they're having to do and their remote working, it has caused them to redeploy, rethink and reprioritise what they are looking at. That doesn't mean that economic crime is any less of a problem. It just means they have additional priorities. Regulatory and policy reform. So similarly to the FCA, many national, supranational and international policy departments have activated business continuity plans with most of all staff working remotely or deployed to respond to COVID-19. This has in some jurisdictions resulted in significant pause in new AML, CTF policy and legislative initiatives. This is further compounded by the suspension of core meetings of some of the legislative decision-making bodies and their prioritisation and focus on COVID-19 emergency matters. Again, it doesn't take away the importance of this matter, it just means there's other things that have come up and diverted resources. On suspicious activity reports, obviously banks and other reporting entities continue to file those, and you should continue to do so. And so far, the NCA has continued to review those as quickly as they can, and have in fact now created 3 new SAR glossary codes relating to the criminal exploitation of COVID-19 pandemic to help them understand more quickly the challenges that are arising specifically related to COVID-19. FIU analysis. Of course, a large number of NCA staff are also working remotely to the extent that information technology systems and security does allow it. The SAR process wasn't ever perfect pre-COVID-19 pandemic, and therefore, of course, the number of clients have been experiencing delays in receiving responses from the NCA. It doesn't mean you don't continue to follow that process, but it does mean that you may end up incurring additional delays. International cooperation. Cooperation is such a huge part of the fight against financial crime, and in an ever-growing international and global economy, cooperation between jurisdictions is paramount. Due to remote working staff, again, there are delays in receiving those international responses, and therefore the cooperation, whilst it's still absolutely a priority, is delayed somewhat. In relation to law enforcement authorities, the NCA this month launched a new initiative, bringing law enforcement and government together with the private sector to tackle criminals seeking to exploit the COVID-19 crisis for financial gain. The new Atello COVID-19 Fusion Cell, what a funky name, led by the National Economic Crime Centre, the NECC, and co-sponsored by the private sector, brings together experts from across the sectors, including financial sector, insurance companies, trade bodies, law enforcement, and the wider public sector. The cell aims to rapidly share information on changes to the economic crime threats related to COVID-19 and to proactively target, prevent, and disrupt criminal activity, protecting businesses and the public. The Fusion Cell will work in partnership with industry to identify new trends and threats and decide on the most appropriate way to tackle it, building on the expertise of both the public and private sectors. The Fusion Cell will remain a virtual body during lockdown, convening regularly to discuss economic crime threat picture related to COVID-19. They also produce a weekly public-private threat dashboard, including high-level SAR trend data to inform areas of proactive tactical development and disruption action. Insights from developing the Fusion Cell have the potential to inform the longer-term ambition of developing the capability to spot and stop economic crime before it happens, with real-time insights and disruptive activity through public-private data sharing. So while a lot of what I said so far is actually that things have become delayed because of COVID, actually there's a lot of new thinking going on because of it. Because of new threats, new initiatives, etc., all coming out, it will actually enable us to speed up the fight against financial crime in certain ways and rethink it and potentially refresh our mind where previously we've been looking at things in a very fixed way. Finally, for myself, in relation to the private sector, the large majority of financial institutions have initiated business continuity plans. I'm sure many of you have done that in response to this crisis. Some banks have closed branches. Many face challenges with outsourcing centres, limited services and redeploying staff. One of the huge risks, and something that we've definitely seen, is that unfortunately because of this, and similar to what I've described from some of the other areas, the financial institutions have been reprioritising their AML and CTF efforts to focus on broader prudential and stability measures, and we completely understand why, but remind that this is still a continued threat and something that needs to remain a priority within your firms wherever possible. So I will now hand over to Johnny, who will look at a more detail at those threats and challenges that some of you may be experiencing.
Thank you, Fiona, and thanks everyone for joining us today. It's nice to see such a large number of people on the call. So we're going to have a look at some of the emerging risks that have been highlighted since the COVID-19 pandemic started, including fraud, cybercrime, changes in financial behaviour, financial volatility, and misdirection. We're also going to have a look at some other predicate offences that appear to be on the increase, or there may be an increased risk from. So, fraud threat. The Financial Action Task Force has outlined a number of threats, a number of fraud threats that may be evident, and these appear to be increasing. Impersonation, for example, where criminals may look to contact government officials or financial services staff with the aim of acquiring sensitive information that could be used for the benefit of criminals. Criminals may also look to impersonate hospital staff or medical staff or government officials to acquire information or to divert funds related to COVID-19. Unfortunately, this is likely to increase as government loans and grants are increasingly paid out, both by the UK government and governments all around the world. Counterfeiting is also a risk, including essential goods such as medical supplies and medicines. High demand for certain items provide an opportunity to sell fake goods or goods which are no longer fit for purpose, like medical equipment or pharmaceuticals with expired use-by dates. And I think we've all seen the headlines of PPE equipment that's not fit for purpose being sold around the world. Goods may be ordered, paid for in advance, but ultimately never delivered. And the marketing of miracle cures, which again we've seen in the news, which make spurious claims without scientific basis, have been in the headlines in recent months. Fundraising for fake charities is also a potential increase. Scams are increasing, with criminals impersonating individuals and organisations or hijacking legitimate campaigns with false banking details. Fraudulent investment scams are also a risk relating to false products and services, some claiming to detect or cure COVID-19, again without any basis in science, have also increased. Stocks issued by smaller companies may be particularly prone to abuse, as they will often have reduced obligations for public submission of information, reducing the ability for public scrutiny. Cyber threats. So there's an increased opportunity for cyber threats as the pandemic has progressed. There's been an increase in remote transactions. There's an unfamiliarity with online platforms and an increased use of unregulated financial services. There's also increasing innovation on the part of criminals. They're finding new ways to bypass CDD measures, pressuring firms to forego the necessary checks or to speed up the process. Misdirection. Now, this is an interesting one. It's been noted that there's been a potential exploitation of stimulus measures. Economic support to both individuals and entities may provide a fraud and subsequent money laundering risk. Risks that are evident from erroneous claims for financial assistance or abuse of loan and grant schemes may also be prevalent. Increased movement of funds to high-risk jurisdictions. Emergency financial aid to poorer countries is at an increased risk of being targeted by criminals or corrupt officials. Lax legal, regulatory, judicial and law enforcement frameworks in high-risk countries and developing countries may make it harder to prevent, identify or react to nefarious behaviour. Corrupt and informal methods of securing lucrative government contracts without normal scrutiny may also be on the increase. Of course, the pandemic has seen a massive change in financial behaviour. There's been a reduced use of branches and an increased use of remote transactions. Juxtaposed against the decrease in physical banking, with bank branches being closed or operating with reduced hours, reduced capacity and services, there's been an increase in online banking, requiring institutions to increase resources in areas such as onboarding and identification and verification. Tactical responses from supervisory bodies has included an allowance to postpone requirements that would have, just a few months ago, been considered sacrosanct. Financial Action Task Force notes that some financial institutions may not have the capability to deal with increased remote activities, such as identification and verification. Unfamiliarity with online platforms. We live in a digital age, but there remains a significant number of people who are not savvy with technology or do not have access to remote platforms. This includes, but may not be limited to, the elderly, low-income groups, those living in remote locations, indigenous populations. The test run that we conducted for this webinar will attest that even those with technological confidence can find new technology challenging. The Financial Action Task Force has outlined that banking fraud is increasing as criminals look to take advantage of digital confusion. Unregulated financial services is also a risk. Non-traditional, unregulated, unlicensed, and potentially criminal provision of financing may become increasingly common as people find it increasingly difficult to access financial services through legitimate means. This has the potential to leave those already in a vulnerable position in even more dire circumstances over the medium and long term. Financial services will undoubtedly find it difficult to find a suitable balance between existing and new customers and decide to focus on maintaining an existing portfolio of clients rather than growth. Financial volatility. Real estate and businesses which are struggling financially may become increasingly attractive to criminals in an economic downturn. Illicit funds can be more easily layered into legitimate finances through the restructuring of existing products and services. Illicit funds previously locked into businesses could be released as part of insolvencies, for example, and an increase in overall insolvencies could provide useful cover for criminals. Individuals and firms may look to reduce their tax burden through tax evasion as well. Predicate offences can increase, including burglary, theft, fraud, and wildlife crimes such as poaching, and the AML and CTF resources available to firms may decrease. There may be an increase in physical cash transactions. This may benefit opaque financial activity both during the pandemic as well as after it, as increasing volumes of cash, which cannot easily be traced, are routed into other commodities with equally low levels of traceability, gold, for example. Criminals which have gained access to bank facilities can find it easier to withdraw large volumes of funds before illicit activity is identified and stopped. The risk posed by virtual assets has also potentially increased. Virtual assets can and have been used for money laundering purposes, and the Financial Action Task Force notes one such case where proceeds of fraudulent COVID-19 medication were laundered using virtual currency. Financial volatility has potentially increased investor fraud and insider trading as assets are liquidated in response to and as a result of COVID-19 and market uncertainty. This can result in increased opportunity for insider trading to occur. Securities offerings linked to fake COVID-19 medicines and products has also been widely reported in the press. So we're going to have a look at some other predicate offences now. Human trafficking and exploitation of workers. The vulnerability of certain groups in society may become even more pronounced during the pandemic. Criminals may look to exploit this. Government agencies and law enforcement may have a reduced ability to identify and react to human trafficking and exploitation of workers. Online child exploitation. There are alarmingly reports of increases in the production and distribution of online child exploitation. Children are more vulnerable as they're spending less time at school and more time at home. Lockdown has also increased the demand for such material, which is often sold for profit by organised and often global underground criminal networks. Organised property crime is also at risk. Uninhabited, unused and underused property can provide an increased opportunity for criminals and allow them to go undetected. Additionally of note is the threat of terrorism. You may have seen in the news yesterday that the Metropolitan Police have warned of the impact of COVID-19 to the terrorist threat in the UK, as people have spent more time online and have potentially increased their chances of becoming radicalised. I'm now going to pass on to Michael Knight-Robson.
Thanks, Johnny. Hopefully everyone can hear me okay. I'm sure Fiona or Johnny will give me a virtual nudge if not. So, over a month ago now, the FCA issued a statement on financial crime systems and controls during the coronavirus situation. And hopefully you've all had a chance to review it. But just to remind ourselves that although the majority of financial institutions are, of course, experiencing operational challenges due to staff working remotely, the fight against financial crime continues now more than ever. And as Johnny has just highlighted, in the increased risks we're seeing, it is important that regardless of the current climate, firms should continue to operate within the legislative framework of the AML CTF systems and controls. However, it wasn't all doom and gloom. The FCA did recognise in their statement the difficulties that are occurring and therefore permitted firms to take a risk-based approach in perhaps delaying some activities, such as your ongoing CDD reviews and reviewing transaction monitoring alerts. Further, although not mentioned by the FCA, wider framework controls such as the MLRO report could be delayed, so long as such matters are addressed as soon as reasonably possible. Of course, activities such as the MLRO report are key, and a key update from you to report to the board on the firm's financial crime risks and an assessment of whether controls are working effectively. Therefore, you should make sure that you still continue to provide senior management with regular updates through monthly MI on such matters, and I'll go into that a little later. But a risk-based approach is key, as it always is in AML. For example, high-risk customer periodic reviews should not be delayed unless absolutely necessary. And on the subject of conducting due diligence on existing customers, Regulation 31 of the money laundering regs requires the account to be closed where the information is not provided. However, in the current situation, firms should make reasonable efforts to collect this information or consider whether you can be flexible to be satisfied with the customer's information before taking a decision to close the account. And again, we'll talk a little later about what flexible means and how you can utilize other methods to verify a customer's identity. So we've looked at the various emerging risks that are occurring from the COVID-19 crisis, and the message from the FCA is, as I mentioned before, continue the fight against financial crime. But what controls need to be amended or enhanced to ensure you remain compliant during this time? Now, for those who have attended one of our seminars or briefings before, this image won't be new to you. To us, these different components make up a typical AML framework: governance and oversight, risk management, policy and procedures, due diligence, ongoing monitoring, data management, investigations and escalations, and of course, training. Now, the FCA expects all firms to have a framework which has all of these components. But of course, the level of intensity that the controls that sit within each component will need to be based on your inherent risks. Now, unfortunately, we don't have time to go into each component, otherwise we'd be here until lunchtime. But I wanted to pick up on a few and provide an insight into what we believe you could or should be doing. So first things first, governance and oversight. The tone from the top is crucial during times of uncertainty. And when we're entering economic difficulty, it's only natural that business looks to see how they can increase profit, and cutting costs may seem like an option. And therefore, it's important that senior management continue to support MLROs in ensuring that there is adequate resource to mitigate the firm's risks. It is little actions like these from senior management which help build a strong culture of compliance. Yes, firm-wide communications do go some way, of course, but actually showing that when push comes to shove, they believe that financial crime is a serious risk and realize that you require the right amount of resource to combat it. Now, compliance monitoring is an activity which some may see as an area which could come under the FCA's recognized delay activities. In fact, in our view, this is an area of incredible importance. The ongoing monitoring by the second line of defense allows you to get comfortable that your AML systems and controls are working effectively. But you might want to think about what areas are really important right now to understand that they are working effectively. For example, it is likely that the majority of firms' new clients will not have been met face-to-face recently, and therefore you should be eager to know that your face-to-face onboarding controls are working well. What are the enhanced measures you place when you don't meet the customer face-to-face? Is it an extra piece of identity documentation, or is it that identity documents need to be certified? Whatever it may be, it is key that these extra controls you have in place for non-face-to-face relationships are working effectively to mitigate the risk of known criminals accessing the financial crime system. Further, should you look to adjust your transaction monitoring system, and I'll get into that in a little bit later, it is important that you monitor this closely as well. And lastly, on governance and oversight, management information is paramount in providing senior management with a view on the firm's financial crime risks, issues, and matters such as are the controls working effectively. Now, if you use an example of new customers being onboarded non-face-to-face, then this is an increased risk. Therefore, this sort of increased risk should be highlighted to senior management. If you're seeing a spike in cash withdrawals during a time when cash is extremely limited in circulation, then again, this also needs to be highlighted. And for KPIs, or key performance indicators, such as ongoing reviews, looking at the FCA statement, ongoing reviews can be delayed slightly during these times. But this will, of course, create a backlog. And it is advisable that management are aware of this, knowing that you are running in the red, but that there is a plan to get back to normal and clear the backlog later in the year. Information is power, and it allows clarity for all. Next up, risk management, and specifically your financial crime risk appetite statement and firm-wide risk assessment. Now, it is important that your business model is reflected in the risk appetite statement. Many clients we work with, we advise that having quantitative risk appetite metrics is incredibly useful to understand exactly what your board's appetite is and whether you're working inside or outside. Such example metrics may include the number of high-risk relationships or the number of pet relationships, perhaps even the number of non-UK resident customers. This will help draw a clear picture of your risk levels. Now, of course, it may be that during a time of economic downturn, the firm's risk appetite may increase to help increase business, which is, of course, absolutely fine and within a firm's prerogative. Should there be an increase in the number of, say, high-risk relationships you're allowed within your appetite, then an assessment should be made as to whether the current metrics are in line with your current appetite. Otherwise, you have a risk of appetite statement, which is continually going to be rated red. And regarding the firm-wide risk assessment, we always say that we'll update the firm-wide risk assessment at least annually, or if there is a major change in business or regulation. Well, this is that moment. This could be that ad hoc review that you may need to conduct. If your risks are changing and changing dramatically, such as non-face-to-face customers, or an increase in the volume of non-UK transactions, for example, then it may be an idea to use that quantitative data to reassess your inherent risks. Of course, we're not saying that you should be reviewing and reassessing your risk appetite and risk assessment if you think that in a few months it'll be back to business as usual. But as Fiona highlighted at the start, I think it's fair to say that there is going to be a change in how we do things, how we conduct business, and some aspects of the last 3 months may stay. And therefore, it is worth thinking now, if certain risk levels are to remain, then your risk management framework should reflect this, as well as consequently your control framework. Moving on to due diligence. Now, the big headline for me is that it is important that you are as flexible as you can be when it comes to customer due diligence. As we all know, all customers are different and CDD files rarely look the same. And when it comes to AML, there's not always a round hole for a round peg. And the COVID-19 crisis is testing us to be ever more flexible and risk-based in our approach. Now, as the FCA said in their statement, they expect firms to continue to comply with their obligations on client identity verification. And thankfully, the regulations and industry guidance has already provided us with multiple ways in which we can verify the identity of customers remotely. But what this situation allows us to do is reassess what we have in place. What allows us to do is A, receive specific guidance from the FCA, which is gold dust. B, fine-tune our controls and allows us to reassess what we have in place at the moment. And C, allows us to, it's an opportunity to understand what we're using to verify client identity electronically. Now, FATA in March released a paper on digital identity, which provides examples of technology that can be used to establish digital ID, such as electronic databases, digital credentials, biometrics such as fingerprint, facial and voice recognition, and digital application program interfaces, platforms and protocols that facilitate the identification and verification process. Now, regarding non-face-to-face customer relationships, FATA states that identification and transactions that rely on reliable and independent digital ID systems with appropriate risk mitigation measures in place may present a standard level of risk and may even be low risk. So, for example, in the case of non-face-to-face onboarding, there is a fraudulent risk of an individual using another identity. However, using a digital identity, you can verify identity evidence and a biometric of the applicant against information obtained from the issuer or other authoritative source. Now, unfortunately, we don't all have endless AML budgets to use the latest biometric technologies to verify the identity of a customer. So there are other examples of where firms can be flexible and risk-based in their approach to verifying the identity of a customer. For example, industry does not, or at least should not, accept passports or driver's license as identity documents which are expired. There is, of course, that increased risk of fraud. However, what if your passport expires this month and your new passport has not arrived yet because Her Majesty's Passport Office is working on urgent passports only? Now, it would be fair and risk safe that if a customer provides you with an expired passport, I'm talking about a passport expired in the last few months rather than sort of say last year, then you can accept this document as a verification of their identity. Another route is to ask customers to submit digital photos or videos for comparison with other forms of identification gathered as part of the onboarding process. For example, if you're accepting an expired ID or scanned copy of a customer's passport, then asking the customer to take a selfie can be a way to prove that the identity documents being submitted are for the person they say they are. Now, I suggest not allowing a photo which could have been posted on social media so that a criminal can't just obtain the photo from there, but perhaps asking the customer in the video or photo to say a phrase or hold up a piece of paper with a phrase in it, whatever it may be. The ultimate issue with non-face-to-face relationships is that you have to become comfortable that the person on the other end of the phone or email or online application is who they say they are. And if you can get comfortable with that, however outside the box it may be, then you can sleep well at night. It is, of course, important to ensure that should you begin being more flexible with verifying the identity of customers, that decisions should be clearly risk-assessed, documented, and go through appropriate governance. And this includes amending policies and procedures and ensuring that there is evidence of approval from senior management, so documenting minutes of certain committees or board meetings which note their approval of the new procedures and processes. Amending your customer risk assessment to reflect that more customers are non-face-to-face relationships, and therefore the weighting of delivery channel of the customer risk assessment needs to be amended. And lastly, making sure that you provide suitable training and communications to staff on the new process to help embed that process. And then just going back to the governance and oversight component of your framework, if you are changing processes, then your compliance monitoring plan needs to reflect this. A new and unknown process may lead to errors, and to help embed that the new control, you need to monitor it more closely. Now, looking at ongoing monitoring and specifically transaction monitoring, well, I don't know about you, but my spending patterns have certainly done a complete 180 recently. Now, the money laundering regulations under 2811A requires firms to conduct ongoing monitoring of a business relationship, including scrutiny of transactions undertaken throughout the course of the relationship to ensure that the transactions are consistent with the relevant person's knowledge of the customer's business and risk profile. Now, COVID-19 has resulted in the general public making a lot of changes to their behavior. Most of these are, of course, not suspicious, but it does require you to reassess what your client's activity looks like now and possibly in the future. Now, when we assist firms with implementing a new transaction monitoring system or reviewing their current transaction monitoring systems and controls, one of the first things I ask is, can you provide me with a document which outlines your transaction risk profile? How many transactions per day? What is the average value of transactions per day? The number of credits versus debits? The number of transactions outside the EEA? Understanding your transaction risk profile is the first step in building an effective transaction monitoring system. Therefore, I'll ask you, how has your transaction risk profile changed in recent months? Now, one thing for sure is that cash is pretty much obsolete now. I mean, whenever I go to the shop, usually the smaller corner shops, and even my local fish and chip shop actually as well, when they say they're cash only, I'm completely gobsmacked. Cash doesn't seem to be around anymore. And we all knew that cash was starting to whittle out of the economy, but this obviously has occurred a lot quicker than we all thought. And no doubt that once this is over, cash will start to come back. Not in the same volumes as before, but to some part. But what our transaction monitoring controls should be picking up more than ever is cash withdrawals and deposits. Therefore, you should be thinking, are my transaction monitoring rules and scenarios still relevant? Is the threshold for an alert of cash withdrawals of more than £1,000 over 7 days still applicable? Should it possibly be £500 now? Or an alert for more than 3 debit card transactions in one day? Does this now need to be closer to 5? Or given the economic volatility, as Johnny mentioned, people are trading more often. Therefore, do you need to increase the amount of trade before an alert occurs? What about if people are removing large sums of money from their investments? That may just be because of the economic volatility rather than suspicious behaviour. It's coming up to 3 months now since the government put us into lockdown, and it's a good time to reflect on your transaction risk profile, on how your risk transaction profile has changed, and thinking about your business model. Is it going to continue like this? If so, it's time to start making some changes to your system. Now, obviously, working remotely has been a challenge, I'm sure, for a lot of us, beyond having to juggle a work life and being a parent, but also having slower internet or the occasional being locked out of shared drives or accessing customer relationship systems. It's also taking longer to get hold of IT. But data management and data security is more important than ever. And as Johnny mentioned, there is an increased risk of cybercrime. Now, with individuals working remotely, it is less easy to verify phishing emails such as the CEO fraud email, where the apparent CEO is asking you to transfer money into an account. Now, it may seem obvious, but firms should make colleagues aware of the heightened risk and remind them of the firm's cyber controls in place, such as dual user authentication process. And it's also worth maybe just including a new module within the cybercrime training. It's also important that the right people have the right access, and this includes confidential folders, which may include documents such as our SAR register, that remain locked to the correct individuals, and these continue to be managed properly. Working digitally and beyond paper files is new to some of our clients and perhaps even to some of you online today. But what we must continue to do is ensure we document and record rationale for opening customer relationships, for discounting adverse media hits, or transaction monitoring alerts. Finding a way, either through email or using PDF comment box, to record this is crucial. Unfortunately, the time of the post-it note on a paper file has passed as acceptable. And lastly, you should make sure that your documentation is in a manageable order. Everyone should know where relevant information and documentation is. Having worked on 3 skilled person reviews during lockdown, firms have really struggled to collate documentation because it's on someone's desktop or in a folder on the shared drive, which only one person seems to know how to find. Simple logistics like that. But either way, we are no longer able to get up from our desk, head over to that person's desk and ask them to send that information. Obtaining information is taking longer, and therefore an ordered data management system is really important right now to provide that information efficiently, whether it be to the FCA or the NCA or law enforcement if required. And it's worth taking the time to organise, because working remotely may become the new norm. And with that, I will hand back over to Fiona.
So thank you, Johnny and Michael, for your sessions. Now is your time to answer any ask any questions you may have. Do please write them on the right-hand side of your screen in the little Q&A box. We've got a few questions to cover, so I'll look at those over the next few minutes. But obviously, if we don't get round to your questions, we will respond to them when we circulate the slides. So first question up that we've got is one for Johnny. So Johnny, how should firms balance risk management for existing clients against risk management for new clients, especially if there is a limited resource?
Thanks, Fiona, and thanks for that question. It's an excellent question. I think it's important, it's as critical now as it's ever been that firms ensure that they have an up-to-date business risk assessment. They understand the resource availability and constraints that they have, and that they're taking a suitable risk-based approach. This should allow them to determine where their greatest risks are, and how to best utilise resources and finite resources. No firm has an infinite compliance resource available to them, so they need to target it at their highest risk.
Definitely, and I think one thing I'd add on that as well is that clearly one of the things that we see is that firms make these decisions, they make them quickly, and the thing that can sometimes fall away is that actually they then don't document the rationale surrounding the reason why they took that particular approach or why they prioritise things in a particular way. If you find that you're unable to meet your overall commitments with the existing resource due to the challenges that have arisen, at least document the rationale as to why you did what first. Because then, whilst the FCA may not agree with your approach, at least you can demonstrate why you took that decision, and that there actually was a rationale and thinking behind the risk-based approach that you then took. Great, thanks, Johnny. Just looking through other questions. One for Michael. So you mentioned a lot about obviously verifying customers' identity. What about information such as source of wealth and verification of that? We know that's a big challenge for firms anyway. The FCA is all over that and challenging that anyway. So what if a customer cannot obtain documentation to verify their source of wealth? What should they be doing?
Well, so I mean, what the FCA did state in their statement was that you can seek, it does allow you can seek that additional verification once restrictions on movement have been lifted. So, I guess what firms could be doing is identifying that information, as you would normally, either by email, online, or on the phone. And if it makes sense and you can get comfortable with it, then you could onboard that customer at that time, but then look to request that verification once your customer can obtain that proof.
Great, very, very sensible advice there. Another one, I think, for Johnny. What do we think? Has COVID-19 dealt a final blow for high street banking? Is it all over for that approach to retail banking for customers?
Oh, crikey, that's a really good question, and I think potentially quite contentious. I mean, we know that high street banking has been under a lot of pressure over the last few years. Banks have been looking to close branches with low volumes of customers, and now many branches across the UK are closed altogether. So I think COVID-19 has definitely resulted in increased digital transactions. I mean, this is definitely going to be a short-term blip, and there's a good chance that it's going to have medium and long-term consequences in terms of how people manage their money. It's important to remember, I think, that there's still a large part of society that still rely on high street banking. And they may be less inclined to adopt modern technology. So closure of branches for them may not be an option, and things may not have changed.
Great. Yeah, no, it's definitely a new world, and we'll have to wait and see where things where things get to. Got another question for Michael. So just on compliance and monitoring plan, what are the other parts of financial crime compliance monitoring that should be enhanced during this time? So you obviously touch on monitoring, etc. But in terms of the actual plan, what should firms be thinking about in terms of other aspects they should be enhancing?
Well, I mean, without obviously trying to sort of push the question back to the person who asked, it really does depend on your risk assessment. It's crucial that your compliance monitoring plan fits your risk assessment and your inherent risks. And so as it is now. So, for example, obviously I gave the example of non-face-to-face relationships, but if, for example, you were seeing more overseas transactions due to customers wanting to send money abroad more to family members during this crisis, then you may want to increase the compliance monitoring of your payment screening and making sure it's working effectively. That might be either conducting the reviews more often or increasing your sample and really getting a thorough understanding of whether the payment screening is working effectively.
Great, thank you. And I think we've got time for just one more. So, a very specific question is to Michael. Does your advice on flexible KYC checks apply to government lending, which has to be done quickly? With a little caveat there, are mules harder to detect than the criminals that hire them?
Yes, I think obviously from a flexible perspective and with regards to government lending, yes, these checks will do apply to government lending. The FCA is conscious that some of the government lending is crucial at this time, and it is important that the private sector and the public sector work together during this crisis. And during onboarding, as I mentioned, firms need to ensure they can be flexible in their approach to conducting due diligence. Ultimately, you've always got to look at a case-by-case basis. All cases are not going to be the same. You've got to weigh up everything you have and really think, right, well, am I comfortable in the information I've got? And if you do have to possibly accept something which doesn't quite fit the round hole, then you need to ensure you've got the right senior management approval to show that sort of governance of senior management are happy to accept that risk. When it comes to mules, unfortunately, non-face-to-face relationships do enhance that risk. And ultimately, that's when your expected account activity and transaction monitoring really comes into play. What do you expect these individuals who are acting as mules for criminals to, what sort of activity do you expect from them? And does it make sense once this transaction starts flowing through? So yes, of course, non-face-to-face is making it harder to detect. And that's when your sort of transaction monitoring comes into play a lot more.
Definitely, and I think there's an element of flexibility around in terms of the FCA and other bodies accepting that things are different, but still they are expecting firms to continue with the right obligations in relation to things like client identity, verification, etc. So if you can't get comfortable, it falls outside of your risk appetite to take that flexibility. If you are dealing with exceptionally high-risk jurisdictions where actually applying that level of flexibility will open the floodgates to illicit funds, then don't do it. And then just obviously understand the consequences that has for your business model at this current time. So it's each firm will take their own approach, but being mindful of how the FCA and other bodies have stated that there's obviously that element of flexibility. Great. Well, I think we've covered most of the questions that have been asked so far, and I'm very conscious of everyone's time. So thank you very much for all those questions. Really, really interesting. And thank you again to Michael and Johnny for their great presentations today. I hope you all found it useful. So as I say, we're coming to the end of the webinar. If you did have any further questions, then obviously do please message them, email them in. We are recording the webinar and we'll be sending a copy of the recording and the slides over in the coming days. We've also had a request that if we can send some of the core links to those relevant websites, FCA guidance, etc. And we'll add in some of those into the email once that's circulated. So yeah, I'd like to thank Michael and Johnny again for presenting, and all of you for joining us today, and wish you a safe and good rest of your day. Thank you very much.